Cool. Okay. Okay. Hi, everyone. This is Finance Meets Real Estate. We have Sam Wilson here today. He is the founder of Bricken Investment Group and host of How to Scale Commercial Real Estate podcast. I'm really happy to have him. He's a wonderful person, wonderful guest. So he's going to talk about the multifamily syndication, including like all the details behind how it's structured. His background, a little bit about his background. He's an investor in self-storage, parking, multifamily apartments, RV parks, and single-family homes. And in addition to his real estate experience, he also has diverse background in business ownership, building, construction, and management. If you guys have any questions during the presentation, so we're going to do about 25-30 minutes presentation. If you guys have any questions during this time, please put them on the chat. And if you have questions afterwards, let's speak afterwards, kind of like more personally as well. With that, I'm going to pass it on to Sam. Thank you, Sam.
Hey, thanks for having me, Stefan, and thanks everybody for showing up tonight. It's a pleasure to be with you. I guess a couple of just quick housekeeping items. If you can mute your phone, just so we're not getting some feedback both on the recording and because I have severe ADD and I'll probably get distracted. That would be awesome. So I do again appreciate you guys coming on tonight. You know the topic tonight. What's
just
that?
1 second. Sorry to interrupt. I'm just going to mute everyone and then you unmute yourself.
Got it.
Again. Okay.
Wonderful. Cool. Okay. Yeah, that's great. So, hey, without further ado, I respect everyone's time and, again, value you guys coming on the night. So let's just jump right in. And again, thanks so much for being here. This will be a blast. So can everyone see my screen? Give me a thumbs up if you can see my screen. Okay, cool. Hey, so tonight is the mechanics of multifamily syndication. My name again is Sam Wilson with the Bricken Investment Group. General disclaimer, this is for educational purposes only. Don't take advice I give out tonight and say, hey, this is gospel and go out and act on it. Do your own due diligence. I think this goes without being said, but I have to say that as well. So there you go. Disclaimer over, boring part over. As Stefan said, a little bit about me. And that also is boring. So we'll move on from that too. I do host the How to Scale Commercial Real Estate podcast, which is fun. If you guys are active investors and or passive investors, and you're a passive investor, come on the show. Would love to have you. So reach out to me when this is over. It's a daily podcast show, and I just really value the guests that come on there. Let's jump in. What is multifamily syndication? I don't know the level of you guys, kind of where you guys are in this process. So we're going to kind of give a high level overview of what multifamily syndication is and just kind of run through it. Yeah, an individual or group who organize an opportunity for others. That's comprised of limited partners and general partners, and they participate in the purchase, operation, and sale of course, a multifamily property. We're going to get into what is a general partner and what is a limited partner. If you guys see these terms out there, general partner synonyms, here we go. You can hear the lead. They can be called a lead sponsor, the operating partner, the deal sponsor, the syndicator. It's all the same person. And that also holds true on the limited partner side. The limited partner synonyms, you're going to hear investor, the passive investor, or the equity investor. What happens is that both of these entities or both of these people invest in the asset level limited partnership, or they own shares in it. And we'll go deeper into the weeds on how that works. But before we break down how all that works, let's kind of figure out what has to happen, right? What has to happen inside of a multifamily syndication for it to, be a profitable deal. A deal flow, obviously you got to start with an asset, right? First thing we do is got to find something to buy. So we locate an asset and put it under contract. The next thing, of course, we're going to do is organize the legal side with our syndication attorney. So what are you going to rely on your syndication attorney for? You're going to rely on them for drafting a private placement memorandum, for drafting your offering memorandums, for filing your SEC registrations. A lot of times they'll form the LLCs also at the state level. So that's the second thing that needs to happen. Securing your financing on the debt side. There's several things in here that can kind of happen interchangeably. They're not necessarily have to happen in this order, but you've got to get your debt lined up for, unless you guys are just flush with cash. I'm not, especially when you're dealing with tens of millions of dollars. So, that being said, you got to get your debt lined up, performing your due diligence, interviewing the property managers, obtaining commitment of investor funds and receiving those funds. That's your equity side of the capital stack. And we'll get more into the capital stack here in a little bit. But once all that's done, you close the deal and you implement the business plan. Each syndication will have its own unique business plan because each property, of course, is unique. And then you got two options. Of course, that's already been lined out, but you can manage that asset directly, or you can have a third-party property management firm come in. A lot of people who are starting out, are going to do the direct, or excuse me, have a third-party property management come in, and as you grow, then you kind of build out, because property management is its own business, really. Then you build out your property management side of things. So, of course, the last two things is distribute cash flow to your limited partner investors and to the general partnership, because they got to get paid too. And then you market or sell the property, or market and sell the property, or not, depending on what your business plan is. I interview a lot of people who, they have a 5, 7, 8 year plan on a property. And then there's the random few that come on and say, look, when I buy something, I want to buy it and own it till I die. So those are really long-term investors, but that's just a typical deal flow. Let's talk about some key roles, the seats on the bus, if you will, inside of a general partnership, because these are things you got to be thinking about if you're new to syndication, or if you're thinking, hey, what are the seats on the bus we have to fill? There's 4 main roles. One is your acquisitions person. Obviously, without someone doing acquisitions, there's nothing else that's going to occur. They're dealing with marketing. They're out doing cold calls. They're building lists of assets they want to buy. They're dealing with broker relations. They're doing underwriting on these deals. And then they're making offers and negotiating terms. So that's the first seat on the bus that you got to have. Secondly, is your investor relations person. They're securing the equity side. Let's talk about equity for a little bit. Every deal, when we talked about it before, but every deal is going to have a certain amount of that capital that has to come in as equity, because you can't get it all in debt. If you can get 100% debt somewhere, please let me know. I'd like to talk to that person. But you're going to have some equity investors in the deal. They're also going to be dealing with your investor management platforms, your docs, getting everything signed. I don't know how many of you guys have done lots of deals, but getting through the paperwork phase on the investor relations side can be a daunting task. Even with investor management platforms, there's always somebody somewhere in a deal that you are syndicating that's got something that's a little bit off. Paperwork got sideways, and it just becomes kind of a fiasco. So getting those docs done is a big deal. And, most of those packets I've seen have been well north of 150 pages or more. So it's kind of a lot to deal with. Year-end reporting, K1s, distributions, property updates, and securing your debt. A lot of times your investor relations person, especially starting out, will be working both sides of the financing equation. Asset manager. This is somebody that I think is oftentimes overlooked as a seat on the bus, especially if you have third-party management. You assume that, okay, we bought an asset and we plugged it in with a third-party manager, and it should run itself, right? They just report to you, put money in the bank, and tell you that everything's hunky-dory. That's not necessarily true. You got to manage your manager. So you have an asset manager that comes in and does weekly updates. They do strategic decision making. If they have major CapEx budgets or major contractors that they've got to get in there and money to spend, they want to make sure it's being done correctly. If your asset manager isn't regularly visiting your site, if you guys spend $1 million in capital expenditure and repairs and aren't visiting the site to see the work that's being done that your property management firm is overseeing, then you're asking for trouble. I don't know, you got to just get out on site and actually see what's happening. So your asset manager really interfaces with your third party management. And that's a really key role. And they also ensure the business plan is being executed. The last thing they do is due diligence pre-acquisition. They're out there walking sites, doing major mechanicals, roofs, structure, interfacing with inspectors and people like that to make sure that before they buy the asset, that they can actually do and perform the business plan that, you guys are all proposing. And of course, the last seat on the bus that you're going to need as a syndicator is your administrative side of things. They're the one keeping everybody organized and together. So they're keeping interfacing with the syndication attorneys, the lenders, the business operations. They're keeping the whole thing moving because you've got several different businesses actually all at once running inside of a syndication. I don't think people realize how many people it takes to make, especially a larger scale multifamily property actually work. So that's some of your key partnership or general partnership key roles. Let's talk also about your key industry partners. So that's that's your in-house people, but your people outside, your key industry partners, your CPA and your bookkeeper. Again, remember, you got two companies you're running. You got a general partnership, which is its own LLC. It's got its own set of books and revenue and expenses and everything going into it. And you have your limited partnership that owns the asset. It too has its own set of books to keep track of. So at the end of the year, you're distributing K1s from multiple LLCs, not to mention just the regular administrative bookkeeping that has to happen throughout the year. So you got to have those two people on your team, your syndication attorney, your inspectors, and everybody else we have listed here. These are all people that, if you don't have these contacts yet, start making those contacts, right? Because you're gonna need these people. And of course, your contractor, you won't know until you actually get to the property and know what, geographic region you're working in or what city you're in. But those are, again, just key relationships that you'll have to form along the way. Let's talk about a limited partnership. Your limited partners, what do they do? Most people think, okay, I just give a little money, but they do a little bit more than that, I think. They fund the equity portion of the investment, just like we talked about earlier. If it's a 75-25 split where you're getting 75% debt and 25% equity, let's call it a $10 million deal, you've got to bring $2.5 million to the table from your limited partners. How does their involvement in the company actually work, though? They are owners of the asset in the LLC. So there's one LLC that may own your apartment complex, right? They own shares in that LLC that owns the asset. They are usually completely passive investors. And of course, they're not involved in your day-to-day operations or decision-making. They don't want to be typically. We, as the general partners, typically don't want them to be either. So it's a win-win. For a limited partner, their loss is generally limited to the loss of capital invested. So, say the deal goes completely sideways, which I hope for none of us they ever do. But if it does, their exposure is simply what the capital they put on the table. Somebody could probably find some weird, court case somewhere where the corporate veil was pierced and they came after the limited partners, but it's unlikely. Most of the time, we just know that, hey, the limited partners can only lose what money they put in the deal. But why do we need them? Because we need to fund the equity portion of the capital stack. Of course, your capital stack is traditionally, and again, this is high level. So I know there's a million ways that this can be structured outside of what I'm presenting tonight, but in order for brevity's sake and actually getting down to business, we're going to keep this short. Your capital stack's debt, which is where you get your lender plus the equity from your limited partners. And again, like we talked about earlier, they fund the equity portion of that capital stack. That being said, you might need more money than maybe the 75-25 requirements, going back to the $10 million deal, right? So let's say it's 75-25 and they bring 2.5 million, but what if you weren't able to necessarily get your capital expenditure, all your repairs, your maintenance, your upgrading all the units, all the value add plays that you're doing, maybe you weren't able to get those funded via your debt partner or via your lender, right? You're gonna have to raise that capital from your equity partners. So you're gonna have to go out to them and say, "Hey guys, we got $2 million in renovations that we're gonna do at this property." So you're gonna up that 2.5 million now to 4.5 million that you're gonna have to raise from investors. Not ideal, but that certainly can happen. The other thing you need LPs for is operating account funding. You're gonna need some money in that till. Especially right out of the gate, just to make sure that you can pay all your bills and keep the project moving forward until you really get enough cash flow in to cover that. And lastly, a lot of lenders are requiring debt service. I've seen it 12, even up to 18 months here recently, where they say, hey, you could have 18 months of debt service in the bank, which they're scaling that back some, but that's a lot of money that you have to show to your lender pre-close in order to get the deal done. So you're gonna have to raise that debt service from your equity partners as well. So that's kind of where that's the high level view of what your limited partner's role is in a syndication. Without further ado, I just want to say, hey, here's some free resources. So this is an absolutely shameless plug from me. So there's a few guides on here, and I'm going to share the link to all of this, to this whole presentation when we're done. So no need to worry about this right now, but I've got a few free resources on my website that if you're just starting out, I think will really help you out. There's two things I want to point out in particular. One is the guide at the top, learn how to replace your income through investing in real estate. And the second one is learn how to vet a deal in 10 minutes. When I was starting out, I spent an inordinate amount of time vetting the wrong deals. I spent tons of time looking at something, I'd get an hour into it and start digging into the particulars on it, maybe 2 hours in, and then I'd be like, this probably isn't for me. And so I really learned the hard way that I can invest a whole ton of time and get absolutely nothing done. And so I created a guide that really kind of narrows and helps both us as active and passive investors come along and say, hey, you know what? This is what my buy box looks like. And anything that doesn't fit inside of that buy box, we throw out. So again, this is a shameless plug. And lastly, of course, join the Bricken Investment Group Investor Club and those links again. And I'll share all this with you when we're over or when this presentation's over. So those are some free resources for me. Moving on, let's talk about deal structures. Every deal structure is unique. And again, we're going to go with a high level overview here, but the number of arrangements are just absolutely innumerable. And each deal will have its own terms and conditions. The one thing I would suggest, and I know I just said, hey, you can spend a ton of time looking at deals that, maybe don't fit your buy box. But if you're starting out, spend a lot of time reading as many offering memorandums and as many private placement memorandums as you can, just to get a feel for how these deals are getting structured. And because there's a million ways they can be put together. But let's talk about a typical deal structure here tonight. Again, the general partnership LLC is formed. The GP LLC owns a certain number and class of shares, typically in the limited partnership LLC. The GP also manages the limited partnership LLC. The limited partnership LLC is formed. Investors, we talked about this earlier, your investors buy shares in that limited partnership LLC. And of course, we said earlier that LLC owns the physical asset. One caveat here is that GPs, well, a lot of times I'll get asked by investors to say, hey, Sam, are you investing in this deal yourself? Well, how do I do that? I have to also then buy shares in the limited partnership, right? I have to write it. It sounds goofy, but I'm going to be a shareholder of the limited partnership as well as be a member of the general partnership. So that's how I participate in the deal, by putting my own capital in it. Distributions and profit sharing. So let's talk about some of the structures around that. A lot of times you're going to see a preferred hurdle plus an equity split. You'll see the terms like a preferred return or a 7, in this case, where they're calling it a 7 pref, right? So it's a 7% preferred return, and then it's a 70-30 split after that, or it could be 60-40, 50-50, whatever it is. Again, each deal you look at will have its own terms. But if it's a 7 pref with a 70-30 split, that means that for every basic or for every percentage point over 7, let's say it's 8, let's say the total return, let's call the total return 10%. Then your investors are going to take 70 basis points per percentage point up to 10%. If the total return was 10%. Again, I'm just making up numbers here. So that means your return to your investors would be what, 9.1%? Does that sound right? Because they're going to get 70 basis points for the additional 3 points above the 7 pref. And then of course the general partnership would collect 90 basis points. Other deals that I've seen are just straight 50-50 split. I've got a retail deal working on right now. It's a 50-50 split, if I could speak tonight. Been up since 5 o'clock this morning. And yeah, so the straight split could be 50-50 on deals. It just really depends on the deal. Other things that we're seeing that are unique right now are these new classes of shares where there's preferred with no upside. Because what we saw was a lot of syndicators were finding that their deal either met the cash flow investor that said, hey, I want a monthly check, right? I had a call with an investor yesterday that said, hey, I am more concerned with the monthly check than I am with the equity multiple, which is bizarre to me, but hey, that's his style. And so there's a lot of syndicators that have come out and said, hey, we're gonna make the best of both worlds for these investors. So they're doing a preferred with no upside. Let's say it's 10%. And what do I mean by no upside? I mean that they get paid first, but they do not participate in any upside of the profits upon disposition. But then there's a second class of investors. Let's say they have a second tier. They get 7% preferred return, but they also participate in the upside. So they may get a 7 pref, so they get a lower preferred return, but then they get to participate with a general partner upon disposition. And that's great for the person that's more concerned about the growth of their money than they are with the money coming back to them every single month as a check. And that's something that we've seen really evolve here in the last couple of years, and it's become much more popular. And I think I like that. I like that approach, because then you get to service both investment styles within the same deal. So hopefully that helps out. Let's talk about asset classes. Class A, B, C. Your Class A assets, they're great. They're newer assets. They're easy to manage. They typically have really nice amenities. There's minimal CapEx. One of the downsides to a Class A deal is that there's not really great opportunity for a value add. You're buying a steady stream of cash flow, and that's about it. The nice thing about those is again, there's not much headache, and you got typically a stable renter profile with higher rents. There's great reasons to invest in Class A, just as we'll find there's great reasons to invest here in Class C. But a Class B asset, you're looking 10 to 30 years old. That's something that's a classic value add age of property where it's ready for upgrades, it's ready for a refresh, ready for paint, carpet, tile, whatever it is you're putting in, maybe appliances, maybe some bathroom upgrades. It might have some deferred maintenance. They're typically not, terrible properties. They still attract a good tenant profile. But again, the upside, lies for you as the investor as an opportunity for a value add. And then, again, most of the things you're dealing with in Class B assets is that they're less structural, it's more cosmetic repairs. Class D, I don't know if you want to mute that, Stefan, and start over? I think. Great, thank you. Okay, so Class C assets. They're typically 30 years older. There's going to be some significant deferred maintenance on a Class C asset. Not a reason to run. It just, I'm based here in Memphis, Tennessee. And, if you know anything about Memphis, you know that it's a great place to invest. But I always say you got to come with your game face on, because there's plenty of that Class C asset here that we have to deal with. And it attracts a certain tenant profile that becomes, you just got to know what you're getting into. The great thing is that, you can have significant CapEx. You might see terms like a heavy lift. I don't know if you guys have seen syndicators say that. Well, that's a heavy lift. That means there's a ton of deferred maintenance. You got your work cut out, is what they're trying to say. There is significant operational risk in that, because what if you aren't able to re-tenant with the right tenants? What if you aren't able to run out the riffraff that you need to get rid of in order to improve the tenant profile? You really have to have some significant industry knowledge, in my opinion, to start taking down some Class C assets with heavy lift. The great thing about these, though, is that they can have tremendous upside. If you are able to effectively implement your business plan on a Class C or a C minus asset, and you have, like I said, your game face on, there's enormous upside involved in a lot of those assets. So, that's just kind of your rundown on what a syndication, asset class could look like. Let's talk about debt structures for a second. These are things, you've got a few options inside of your debt structures. You got agency debt. The great thing about those is the length of the term, or the length of the loan. Of course, your lower rates. The downsides of this, you're going to pay a lot of points up front upon acquisition, and there's a ton of third-party due diligence that goes into Fannie and Freddie loans, or even your CMBS or life insurance debt. There's just a lot of red tape you got to get through. And the one that you really got to look out for inside of agency debt is your prepayment penalties. I interviewed a guy not 2 weeks ago. He had a great, he was just starting out when he bought some of these assets, and, they'd made a ton of money on them. So much money that his prepayment penalty was $6.5 million when they sold the property. No kidding. I got this on a podcast interview. And he said, man, it's okay. We're still getting paid. We're making huge upside. He goes, but learn a lesson from me. This is a $6.5 million mistake that not 5 years ago I could have prevented if I'd have known the terms of the loan I was getting into. I said, well, thank you, sir, very much. That's a $6.5 million mistake I don't want to make. Thanks for learning it for me. The upsides, again, on some of these agency debts, though, are that they're assumable. And that's great. But again, you got to find the right buyer, and you got to find the right person and team that qualifies to take it over. So those are just some gotchas inside of agency debt that you got to look out for. And also the quarterly reporting requirements. There's just a lot of administrative burden that goes into those, that, there's some strings attached to the long-term lower rates, right? Bridge debt is really interesting, and it's something we've seen kind of a lot of growth in here recently, is bridge debt, because it's fast money. And oftentimes you find that the price of money is worth, or the speed of money is worth more than the price of the money. And so bridge debt, you're going to look at a 3 to 5 year period typically on a bridge loan. I've seen it up to 20 million, maybe 30 million with some bridge lenders. It can have an interest only period, which is nice. They're pretty flexible in the IO period. The other thing is you're going to pay higher rates. We closed a property here recently that required bridge. just because of the particular terms of the deal. And I think we paid, I don't know, we're paying like 6% on it or something, maybe 6.25. It's okay. I mean, the deal still makes sense, but the speed of the money was worth more than the price of the money, especially if we don't hold it long term. So, you can calculate all that stuff out and see if it makes sense for where you are. But also with bridge debt, because it's short term, the prepayment's minimal or non-existent. So as compared to agency debt, you go, okay, they expect you to refinance this out. Their money is made on the turn and on the higher rates. And if you prepay it, typically it's not a big deal. Again, every loan will be different. The other cool thing about bridge debt is that you can oftentimes get it underwritten on stabilized versus as is condition. So you said, hey guys, we got a heavy lift here on a Class C asset, and this is where it's gonna be when we get this stabilized. A lot of times they'll underwrite based on that versus what it is right now. Because if all you can do is underwrite based on what it is right now, you're going to be limited in the amount of capital that you can secure. The other cool thing on bridge debt is that a lot of times they'll just give you a line of credit as opposed to needing to raise capex via either equity partners or via debt. So and because it's lines of credit, and you're not paying any money on any dollar you don't use, which is amazing. Because if you don't need it, then I mean, why raise it in equity? Why raise equity to cover capital expenditures? That just drives down returns. So that's kind of a cool feature about it. There's also less asset class restrictions inside of that. Conventional, of course, is going to be some combination of all those things above. And then just a few things to note here, I think they're important. Is the business plan will drive what debt terms are acceptable and required. And the longer, this is another thing I've run into, and I've just been told over and over, so I feel like I should pass it on, is that the longer the length of the loan, the more flexibility you have. Don't get stuck in a corner. We saw that in 08, where a lot of guys had debt coming due, and guess what they couldn't do? I mean, lines of credit, the lenders had just, I mean, it was frozen. The credit markets were frozen. And so they just got hammered because their loans came due and they didn't have the time to really just wait it out and make even execute their business plan. So it became a big deal. So the longer the length of the loan, the more flexibility you have. And of course, your debt terms can break a deal. An ability to sell. I spoke with somebody recently. They said, man, we can't sell just because, and this other person, they couldn't sell because of prepayment as well. But the prepay was so high. They just said, we've got enormous upside in this deal. We could sell it, but they just couldn't stomach the prepay. So those are some things to look out for in debt structures. Let's talk a little bit about GP, general partnership compensation. Here's a few things that I commonly see inside of general partnership compensations. And you can charge one, none, all. You can fee your investors to death, which I don't recommend. For us, there's only one fee we charge, and it is an acquisition fee. I charge a 2.95% acquisition fee on everything we do. Outside of that, there's zero other fees. There's no disposition, refinance, construction management, asset management, or even buyer's brokerage fee. It's just not there. Well, of course, you might have a buyer's brokerage fee depending on the deal. That's something maybe we can't get around if it's a really nice deal. But outside of that, to our investors, that's all we charge. But these are again, this is just a large scale. Look at this from a high level view. This is how general partnerships are typically compensated on the fee side of things, independent of in the profit share. So that's hopefully that's of help there. Let's talk about a deal, a potential deal. This is just an example investment, and I know we talked earlier about the preferred hurdle, but I wanted to look at another kind of return profile for a limited partnership with a little different twist on it. Because I know, like I said, there's, the number of structures are innumerable. We'll go through this one pretty fast. In this case, the preferred return is 7%, but what the sponsor did was that said, hey, you know what? If we make anything less than a 15% IRR, so for those of you who aren't familiar with IRR, that stands for internal rate of return, which basically takes into account the time value or the timing of the cash flows that you receive over time, right? Let's say somebody said, I'll give you $1 billion in 100 years. How much is that worth to you? Zero, right? I mean, it's absolutely worthless because none of us will be here. So that being said, if you could have $1 billion a day, though, it's worth a lot more. But also, it takes into account the buying power of the dollar, because obviously in 10 years, you're going to be able to buy less with a dollar than you are able to buy right now. So it takes into account the timing and when you receive the cash flow. So we said, so enough about IRR. That's a confusing topic. You can go research it if you like and bury your head in IRR conversations. But we said, hey, look, anything less than 15%, we're going to do a 70-30 split. Anything over 15% will be a 50-50 split. So, that's good for us. That puts the onus on the sponsors to perform. and to perform quicker. It gives us incentive to return capital faster back to investors. Let's assume we can do a cash out refinance in 3 or 4 years. The sooner I can return all of their initial equity in the deal back to them, the faster that IRR drives up. Because remember, IRR takes into account the timing of the cash flows. And when your initial equity investment comes back sooner, then your IRR goes up faster. So that's something else to look out for. And on that note, this is something I didn't put in here, but this thought just came to me, is that you got to look out. And again, there's two ways that people calculate their returns to their investors. And you got to know, you need to ask your sponsor this directly if you're a passive investor, or decide for yourself if you're an active investor and you're raising money. How are we going to do this? Do you treat cash flow as a return on capital or a return of capital? And so for us, and that changes things dramatically, because I was looking at a sponsor one time, and he was like, we got a 40% average IRR. I'm like, 40%? That's insane. What do you mean? Oh, I found out that their cash flow distributions were treated as returns of capital over the life of the deal. Like, wait, that doesn't really help me any, because by the time you get, and that's good for them, because by the time you get to the end of the deal, they don't owe their investors any money other than the 70-30 split or whatever it was they agreed upon. So the investors will still participate in the, in the profit split, but no longer be owed that equity investment at the end of the deal. So that's something else just to look out for. There's a sample returns page. We're running short on time, so I'm gonna shorten this up a little bit. We could talk about cost segregation. Again, I'll send this link out to you. This is an important part of, especially right now with bonus depreciation. But you can follow, there's a podcast link on this page where you can follow it and learn from Frank Judici what cost seg is and kind of how it works. It's a pretty cool thing that we're able to do. Here's a deal that we were working on in the first year. Basically, we're able to benefit from bonus depreciation by 45 to 55% of their invested amount in year one. So they put 100 grand in, and they get $55,000 that they can write off on their taxes that year from bonus depreciation. So that's something cool. Again, we don't have time to dig into the ins and outs of cost segregation. I think last or close to last. I'm not quite sure how many slides there are here, to be honest with you. This 506B and C, these are two different offering styles. And I know you guys are probably all familiar with this, but I want to kind of run through it real quick. If you are raising capital, a 506B says, look, hey, we have an unlimited number of accredited investors that we can bring into the deal, and we can have 35 non-accredited investors. Well, what is an accredited investor? And I'm not sure I have the dollar amounts on here, but an accredited investor is somebody that makes $200,000 a year as a single person, $300,000 a year as a married couple, or they have over $1 million in net worth, excluding their personal residence. That's been the basic guidelines to it. I'm sure there's some other nuance to it. And we had some revisions on the guidelines last year. Well, if you hold this license, or if you hold that license, then you could be an accredited investor. But 506B deals are open to non-accredited and accredited investors, right? The gotcha with 506Bs is that you can't publicly advertise. So you can't get out there and put it on Facebook and say, hey guys, I got 300 units that we're taking down in Charlotte, North Carolina. Who wants to get in with us on that? Yeah, don't do that. If it's a 506B raise, you need to call your friends on the phone. You need to deal only with people that you know or have a pre-existing relationship with. And we always say that we put people in a 30-day holding period. So if I don't know you and we haven't talked on the phone probably 3 or 4 times, and we haven't spent some time really over at least 30 days getting to know each other, and you're 506B, then you can't get in on our deals. 506C, on the other hand, is much more latitude. It's a little bit more paperwork heavy, but much easier to implement, in the sense that it's accredited investors only. And how do they verify they're accredited? There's several different ways to do it. You can have your CPA do it. You can have your securities, whoever you invest with, your broker. You can have them say, hey, yeah, Stefan, he's got over $1 million in whatever he's invested in. He's an accredited investor. There's some other ways to do it. There's some third-party platforms like Verify Investor, I think, that'll do it. And they charge like $70 to produce a letter that says, yeah, you're an accredited investor. But 506C deals, you can openly advertise. I don't know if I said that yet or not, but those are cool because you can go out and just say, hey guys, wave your flag, wherever you want, and say, hey, I've got a deal that I'd love for you to participate in. And if I don't know you and you call me today and said, Sam, I got $1 million to put in, then yeah, come on, man. Come on in. The water's fine. It's everyone come in. So that's kind of how a 506C deal works. And that really is the end of the presentation today. Again, I'm going to share the links with you before I'll stick them in the chat box before this is over. But this is how you get a hold of me. And yeah, just want to say thanks so much for your time. And we'll see if Stefan has some questions here for us.
Thanks, Sam. That's a lot of great value there. Really appreciate it. And thank you for taking the time to speak to us as well. We have I see a couple of questions in the chat. Like the first question, like from your perspective, what components of a private placement memorandum opportunity summary are crucial but overlooked for new to the game GPs?
Yeah, I think overlooked for a GP or for an LP?
Are crucial, but yeah, that's a good question. I'm not 100% actually what they mean. Well, so it's what components of a private placement memorandum or opportunity summary? Well, so I assume it's more from the LP perspective.
Yeah, and again, I kind of hit some of those earlier on.
Yeah, from the, I believe, LP perspective for new general partners.
Yeah. So if you're coming in as a limited partner, I mean, I think I hit on some of those, high level stuff. Find out how are they calculating returns.
No, GP perspective.
GP perspective.
GP perspective.
I think really you're going to rely on your attorney for a lot of that. You're going to get your checkbook out and you're going to write a nice check to your syndication attorney. I would say find a syndication attorney, especially starting out, one that has insurance. They need to know that what they're writing, they put not only their name on, but also that they have insurance to back it up if they make a mistake. So if the SEC comes knocking on your door and says, hey, Sam, or hey, Stefan, the deal you put out didn't quite comply, and now you owe us $2 million, you want to go back to the guy that wrote the deal and say, hey, man, you call your insurance agent because you got a check to write. So I would say that's a gotcha out of the gate, is to make sure that your syndication attorney is insured and carries insurance for, screwing up stuff like that. Outside of that, the terms of the deal, I read, literally when I get a PPM back, I read every page word for word, and I can't tell you the number of mistakes, even for the guys with insurance and that you write a big check to, that make mistakes. And you go, hey, wait, that's not the right equity split, or wait, because a lot of times they'll put even the property management. I think one deal I was doing, we just did, they had the wrong property management firm in there. I was like, wait, who's this? No, this is the wrong stuff. So that's some other gotchas, is to know your deal inside and out, and then read every page of it. It's boring. It's horribly boring. It'll be 4 hours of your life you'll never get back because you're reading every page of a PPM word for word, but it's worth it. So that would be some of the gotchas I'd say on the GP side you need to look out for.
Mm-hmm. Cool. And another question, so are are distributions made, or like how are distributions made? Perhaps can you walk to this process step by step? Exactly who cuts the check? General partner, property management company.
Yeah, so your property management company works for they work for both of you. They work for the limited partnership and for the general partnership, of course. But who cuts the check? The limited partnership LLC is the one that makes distributions to the investors. That same limited partnership also makes the profit sharing checks and cuts those back to your general partnership, because that's how your general partnership gets paid, is on a profit share. So does that answer the question? I feel like I've answered part of it, but forgot what the rest of it was maybe.
Yeah, if you could just talk through that process step by step on the distributions. Okay.
Yeah, absolutely. So yeah, it really, and it depends again upon the business plan, the business plan that was outlined in the beginning is when are distributions going to occur. And every asset is going to have its own specific asset or asset specific business plan that says, hey, look, we think by 6 months, we'll be making distributions because this is a moderate lift project and we will be able to generate enough cash to pay. It might be, hey, in month 1, I've been part of deals where distributions are getting made 30 days after we buy the asset. So it really comes down to the sponsor communicating what those expectations are. And, for us, we do everything via a portal online. And so it's all done via ACH. But, I guess that brings up a second kind of question maybe that's involved here, is how does the preferred happen, or how does the preferred get calculated? So let's assume that distributions aren't made. let's assume we'll go back to the deal we had earlier. It's a 7 pref and the distributions aren't made. They're not made for 24 months. That's a cumulative preferred return. So if you put $100,000 in and the return is 7%, but no distributions were made in year one, maybe that was the business plan. No distributions were made in year one, and they didn't make distributions till the 730th day of year two, so the end of year two, and they're going to owe you $14,000 in back preferred return before any splits or any other profit sharing occurs. Does that make sense?
Yeah, it does. It does. Because I kind of wanted to go through the step-by-step process. Okay, so we've got a quarterly distribution, right? It's a quarterly distribution to investor. So the hands that touch it calculated the property management company, the GPs, they do a double check on it. It goes out. But could you just talk through specifically the points as you mentioned right there that it goes into the LP? Could you just talk through that step by step, please?
Sure. And Nelson, you don't mind muting, got a bad echo.
Okay, all right. Thank you. See, I'm just so excited about what's going on here in Stefan and you guys, right? My excitement comes through.
No worries. Thank you so much. So basically your property management company is going to write a check to your LLC, to the limited partnership. They're going to pay the limited partnership, after their expenses and everything are paid, they're going to pay your limited partnership the proceeds or from whatever the revenue that was generated, right? They're going to pay them whatever the revenue that was brought in minus maybe a management fee or something else, or maybe it goes into the LLC, then they pay a management fee back. But once that money gets into the LLC, then it's up to the general partners to decide how it gets distributed. So if you have a quarterly distribution that's decided, they said, hey, we owe a 7 pref and there's money in the till, then the general partners say, okay, guys, we're going to write checks now to all of the members of the limited partnership, and everybody gets paid. I mean, it really is quite that simple. I don't know if there's any, maybe I'm missing something, but that's it.
No, we're good. Thank you. Thank you very much.
Okay. Another question. So about using crowdfunding or registered securities dealers or finding co-GP to assist fundraising as one is building track records.
Yeah, that's a great question. And I didn't cover it in the slides just because I wanted to kind of, spend more time on the Q&A session. So yeah, absolutely. Now there's a couple of things because I've both been active and been more on the capital raise side, but just to be for pure compliance perspective, and I'm on these calls every week and I make sure I actively participate in the management of our deals. So that's one thing that you've got to be wary of, is that you can't just show up, bring capital, and then be part of the general partnership as a capital raiser. The SEC frowns upon that. From everything I understand, the SEC frowns upon that. So you've got to be an active member of the general partnership and bring something else to the table besides just raising capital. But I will say this, what we do here, and I partner with key operators all over the country all the time. That's exactly what we do, because there's things that I can bring. I can bring capital. I can bring industry expertise. I can help us get some key partners brought in on the deals. And so I don't want to necessarily be an active sponsor all the time. There's plenty of deals out there that make sense for me and my investors to get involved in that don't necessarily, I don't have to be the lead sponsor on. So yeah, there's plenty of chances to be a co-general partner, a co-GP, as they call it. And I think that's an absolutely fine and perfect way to get started, especially if you can find a reputable operator that you want to plug in with, and you know them well, and you say, hey guys, let's team up. How can I bring value to you? How can I bring value to the general partnership? And then how do I bring my investors along with me for the ride? And that's absolutely a great way to start out.
Great. And the next question, can I learn more about 506? Where can I learn more about 506B non-accredited syndicates?
Yeah, those are really, again, it goes back to who you know, because those aren't advertised deals. So you're not going to see them out posted online. You're not going to, they're going to be more phone call deals, or, they may even be if you have, like for me, if you have come to me and said, hey, you know, you signed up for our investor club. You and I have talked on the phone several times. We've got to know each other over a period of time. And I know that you're a non-accredited investor and I have a non-accredited deal that comes up. Well, now I have a pre-existing relationship with you. So the other thing to do would be to find other sponsors that are out there that may be investing in the asset class that you want to invest in, and just spend some time getting to know them. But spend some time getting their deal flow sent to you, even if you're not ready to invest, but just start grooming those relationships early, because those are, you know, when I send out a 506B deal, it's going to be 506B to only the people that I know that are 506B. And outside of that, it's a pretty closed loop. So really, you just got to kind of insert yourself inside that loop to get a hold of those.
Sam, this is a question from me, Omar. So when you say, you know, it's who you know, starting out for the first time, where would you go? Meetup groups? I mean, it's a crazy question, but I'm new. So
No, that's a fair question, and one that Omar, I apologize, I've not really thought much about. Yeah, where would I go? I mean, you can go to websites like mine. You go to bricketinvestmentgroup.com/join. Join our investor group. Get a hold of our list. Start seeing our deals. Talk to me. I mean, that's one place, but I'm one of a whole bunch of people out there that are you know, commercial real estate syndicators. The other thing I do is probably just go look at the podcast circuit. Go to my podcast. You'll find 200 or probably of the active people I've probably interviewed 170, maybe 160 active deal sponsors, right? I launched that podcast December 1st, and it's a daily podcast. So yeah, I think we're at 198 or 199 today. But yeah, there's probably 170 people out there that you can go to their website, listen to the podcast, go to their website, get to know them, sign up for their list, and just start seeing their deals. I think if you did that and that one thing and that one thing alone, you'll have so many deals you won't even know really where to begin. So I think that's a great easy way to kick it off.
great, we'll do that. Thank you.
You betcha.
Yeah, next question about the kind of LLC structure you mentioned some before. So am I understanding this correctly? Is the question GP would set up both GP LLC and LP LLC, then the investors will buy shares of the LP LLC, which GP LLC will use to close the deal. Also, will both accredited and non-accredited investors invest through LP LLC?
I think I'm finding this question here. Sorry, I'm not technically savvy, so I'm just finding this. Is this from Will? Is that from you, Will? Okay. Yeah. So I'm understanding this question correctly. GP would set up both GP LLC and LP LLC. Yes, that's correct. Your syndication attorney sets up your LLCs typically. Then the investors buy shares of the LP LLC. Yeah. I mean, the way we typically do it is like $1,000 a share, minimum investment 50 grand. So you buy 50 shares in the LLC. And the GP LLC uses that LP LLC to close the deal. That's correct. The LP buys the asset because you want your limited partners to own shares of the LLC that owns the physical asset. That's absolutely true. And then also, will both accredited and not accredited investors invest through the LP? Yes, through the LP LLC. Yes is the answer to that. If it's a 506B deal, everybody piles in. All the shares are worth, well, unless we get into, again, you know, some weird things, but assuming it's a straightforward vanilla deal, all the shares are $1,000 a share, and you know, off you go from that point forward. Does that make sense?
Gotcha. And setting up all that share jazz is probably done through the syndication attorneys.
100%. Yeah, and it sounds a lot more complicated than it is. I mean, they just put in, you know, there's a subscription agreement that tells you how many shares you buy and all that stuff. But once you do it once, it's like, oh, okay. It sounds a lot more daunting, but in the end, it's like, okay, it's $1,000 a share. I'm buying 50 shares or 100 shares, whatever it is, and that's it. So it's not that complicated.
Gotcha. And usually are the GP LLCs and the LP LLCs structured in the same state?
That's a great question. I've seen that a dozen different ways. I have no idea. That's the short answer. For us, yes, it always is, because it just makes sense. I don't want to, you know, maybe your state has a franchise and excise tax, maybe mine doesn't. I don't want to be responsible for trying to figure out. And of course I'm not, because you got CPAs, but I want to pay them an extra $2,500 a year to file in a separate state. You know, I see no reason for that. But again, you know, I would probably consult your CPA and your syndication attorney on that before you listen to me.
Gotcha. All right. Thank you.
Yeah.
All right. As someone who is just starting out as a syndicator, how does partnership, or I guess partnering with others, work? How are they usually structured? Do they typically bring a deal to an experienced syndicator?
Let's see. How does a partnership work? Yeah, I mean that again is outside of my realm of expertise. If you're just talking about a true partnership where it's just, hey, there's two people that go out and decide that they want to start a company. I don't know what the ins and outs of that may necessarily be. Without again getting legal counsel involved in how to structure that partnership properly, like if that's the question. But do you typically bring a deal to an experienced syndicator? It depends on where you are. Depends on where you are in the process. If you are getting debt from lenders that require a certain amount of experience, yeah, you're going to have to bring a syndicator to the table, and you're going to give them part of your general partnership and part of the upside, and that's just a cost. That's just your tuition fee. I mean, that's part of the deal, and yeah, you can bring, and I would advise that. I mean, how many of us want to take down a $10 million asset having never done it before? I don't. I mean, there's so many gotchas and caveats. Bring somebody on that knows what the heck they're doing, and learn from them. Again, that's cheap tuition compared to the mistakes that you can make not bringing someone experienced on. So yeah, I mean, that's typically it. If you're doing agency debt, yeah, you absolutely have to have a certain level of experience, maybe on your bridge debt side of things. I don't know if Jack is on here or not, but there's a good lender friend of mine that I was talking to just before we got on this call, and he said he might jump on. But on the bridge debt side of things, and they specialize in bridge debt, I think it's a bit easier, and maybe that hurdle is a little bit lower.
And you mentioned actually you mentioned during your talk is for your acquisitions guy kind of having a buy box and sort of systematizing your underwriting and sort of acquisitions, selection process, etc. But you guys have like quite a diverse set of, sounds like a diverse set of asset classes, or is it just historically, or like what do you focus on currently, and then what's your buy box in that case?
Yeah. So for us, and I'll answer that question directly, Stefan. For me, the buy box starts for me and what we invest in with our key operating partners. So I've got maybe 4 or 5 guys across 4 or 5 different asset classes that I know, like, and trust, that I have invested with personally, that I know their track record and I know how they operate. And I say, okay, guys, I want to work alongside of you. And so when they ship me deals, I may or may not be interested in it, just depending on, kind of what the parameters of the deal are. And so my buy box is a little bit bigger in the sense that, yes, I'm asset class agnostic, except for, I say that, but there's certain asset classes I don't know anything about. And because I don't know anything about them, I won't invest in them. I'm just completely ignorant on the asset class. But if it pertains to multifamily, self-storage, or RV parks, or boat and RV storage, yeah, I mean, those are things I'm very comfortable working inside of. So yeah, that's kind of how I've defined my buy box. And again, for me, this is a structure that's worked well for me in the sense that I used to be very, very, very niche down. I was buying parking lots and parking garages for several years. Loved that business, lots of fun. The pandemic kind of put that pump the brakes on that business, which, luckily for us, we fared well and actually did fine in that industry, but it just was no longer a viable opportunity for us to really keep drilling down on that asset class. So we spread out. And again, over the years, I've developed many relationships, and it was easy to kind of diversify pretty quickly. So I hope that answers your question, or maybe I just rambled on.
And when you said like 4 or 5 partners, like you're referring to just co-GP partners, like that you have previously worked with. So that's kind of like part of your approach. Okay, but in terms of your acquisition criteria, I guess since you have so many asset classes, it's going to be pretty different. You have are you targeting a specific IRR in your project? Like what's a good IRR? I mean, it's just like, it's always a difficult question, but do you focus more on like the cash flow side, like having like a cap rate versus financing spread, or do you want to get like forced appreciation? Is your sort of I know it's always a mix, but like what is your what are some of your typical targets and like ideal?
Yeah. And I probably, this is a fault of mine. So you're exposing a weakness in that I probably project upon my investors what I project upon what my own needs and wants are. And so for me, outside, and of course, I'm not going to show anything to them I don't like. So that's kind of hard to know what everybody wants. And I got to look at it and say, do I like this? Because I can't bring people in on a deal I don't personally like. So for me, there's a couple things to it. One is, what's the upside? what's your equity multiple look like? And I think that is kind of a more important metric for me even than potentially IRR, because you can manipulate things, again, as we talked about earlier with IRR, by doing return of capital as opposed to return on capital. You can manipulate it by having a refinance early on in the investment, and then you'll just make that IRR astronomical. So I like the equity multiple number. How much money am I putting in, and how much do I get out when the deal's over? Obviously, it's all projected. So that's one where it starts. If it doesn't meet a decent equity multiple in under 5 years, like if we're not doubling our money in 5 years, then why are we doing it? Right? It just doesn't seem to make sense. So we're looking for north of 2 on our equity multiple in under 5 years. It might even be stronger than that. And then you asked about asset classes. Yeah, I have a personal affinity right now for boat and RV storage for several reasons. Not and just regular storage. It's still self-storage is a hot asset class, but given the tenant-friendly laws and tenant-friendly things that have happened here in the last 12 to 18 months, there's been a lot of pain in the marketplace that maybe we haven't seen yet. And just seeing where we're going with landlord laws and things like that is becoming more and more restrictive. And I still invest in multifamily, so I'm talking on both sides of my mouth here, but it's becoming more and more restrictive on the multifamily side. So I want to get into an asset class where it's easy to evict, where it's easy to clean out, and it's easy to manage. And self-storage fits that, regular self-storage. And secondly, boat and RV storage fits it incredibly because they're very expensive assets that people want to park, they want to have covered, and they're very, very, opposed to getting them repossessed or sold at auction because they didn't pay their $100 or $200 a month, whatever it is that it cost them to park it indoors. I mean, I don't, and boat and RV deliveries were up like 25% in 2020, and they're yet again that up again in 2021. I mean, they're just flying off the shelves, and you can't park those in neighborhoods. Most HOAs restrict them. Most people don't want them sit, a 40-foot RV sitting in the driveway. So they want a secure place to park that, and I think that's got a great potential moving forward as an excellent asset class.
Yeah, that's great. So how did you become so asset class agnostic? Like, how did you raise your mindset or like knowledge to that? Like, do you have some recommendations or like resources for our audience, perhaps? Because I feel like if I wanted to invest in even like self-storage, I would not be like particularly knowledgeable just yet.
Yeah. So what I did out of the gate was I came in as a passive investor. I came in on a lot of these deals as a passive investor, and I learned from guys that were way ahead of me, guys and gals way ahead of me. I read tons of books, read everything they put out. And then, I went in and put my money and watched the deal perform. I read all their PPMs. I read all their offering memorandums. I absorbed everything I could from active deal sponsors as a passive investor. Even today, I'm a passive investor in deals, just because, you've got retirement funds and things like that we can't put into our own deals. Probably won't go down that rabbit hole today, but you can't invest your own money into your retirement money into your own deals. So I got to find other sponsors to work with. So that's one of the things I did. I went out and put money with them, and then I got to just, and I hate to say it, I feel bad. There's some well-known syndicators out there, and I'd look back on the amount of time I took grilling them. I'm like, man, I probably wouldn't be as nice to me as they were. So, but that's really how I learned out of the gate was going across lots of different asset classes with different sponsors, and just pick their brain as long as you're buying their time. They're making money on me putting money in with their deals. So, that's really how I did it. I don't know. There's no secret sauce, but hopefully that helps.
Yeah, no, that's great. That's great. And then another question. So is there a waterfall structure that you look for, or one that is a red flag and prefer to avoid?
I can't think of a structure I prefer to avoid. I don't like it like when there is a 50-50 split. And I just said earlier, we're doing a retail deal right now that is a 50-50 split, and that's fine. But I don't like a 50-50 split when the sponsors are taking heavy fees. I think it's one thing to say, all right, look, we're going to take a 2 or 3% acquisition fee, and we're doing a 70-30 split. Okay, well, that's fine. That gives you the motivation to go out and do your deal. But if we're providing all the capital and they're still taking all their fees and they're doing a 50-50 split, you really as the passive investor, I think, stand to not make really the returns that you could in an equal investment with a different operator. So that's one not a big fan of. The rest of it, it really just depends on what type of investor you are. If you're a cash flow investor, then get in on something that produces an income that you can predict. If you are more of an equity multiple investor like me, you want to see your money grow 2 or 3 times in 4 or 5 years. I want to find those deals that have the upside potential to them. So really find what fits you, and then go find those deals, because they're out there. The right deal is out there for the type of investor that you are.
Mm-hmm. And you mentioned, just if I may add a question actually to that, since you mentioned like some of the opportunities to kind of manipulate IRR being kind of like a function of the timing of cash flows, right? And you can like super stretch it if you refinance in 1 year and etc. But then is it under most sort of syndication, legal paperwork that IRR drives the equity split, or have you seen it another way?
I've seen it again. The canned deal that we gave, which is very plain vanilla, was a 7 pref with a 70-30 split. I am seeing more IRR deals out there, where it's hey, once we get over this certain IRR, and again, you got to just know, how that's going to be calculated. Which again, if they're able to return your investor capital to you via a refinance, or a large portion thereof via a refinance. And even if in the offering docs they say, hey, look, cash flow distributions are a return on capital, but yet then we're having a capital event where we refinance the property and we actually return your initial investment back to you. And I forgot, I'm losing my train of thought here, but I think the point was that you can juice IRR that way. I don't know, Stefan, I totally lost my train of thought. So sorry.
Okay, no, sure. But what is, let's say, what's another trigger for the equity split? Would it be like AAR, like annual average return, perhaps, or that you have seen? I was just curious.
I've not seen AAR. I've only seen, just a preferred return, and I've seen an IRR equity split. I've not seen anything outside of that yet. I'm sure.
Yeah. Okay, cool. Yeah. I think that makes sense. Okay, sure. So then what are some extra work that you guys put in, or some milestones that you try to hit to ensure that you hit or go beyond your projected returns?
Yeah. And again, if we can hit projected returns, that's great. One of the things we try to do always is make sure, and everybody says this, so this is a useless phrase, but I don't know how else to say it, is that we try to have conservative underwriting, right? Like you try to under promise and over deliver. And so we want to put a lot of fail safes. And again, for every deal that we invest in, I spend a lot of time with that sponsor's spreadsheets. Like I want to see, and every deal I've passively invested in, I've seen the spreadsheet and I've spent time digging through it. And it'll take you a long time to get to know each person's spreadsheet, because I'm not the brightest star in the sky. And then when you get spreadsheets involved, you got to try to figure out what formulas go to what cell. And when you touch this, like, how are they producing these numbers, right? So that being said, I want to get their spreadsheets and I want to see how it is that this deal is actually being underwritten. And so, yeah, I would say conservative underwriting is part of that. And in our underwriting, making sure that there's some fail safes in there that are, okay, if X, then Y. Stress test the deal and just see how it performs over a range of outcomes, right? Because it's one thing to put it in a spreadsheet and say, okay, if we sell it at 7 cap or sell it at 4 cap, whatever the asset is, I'm just making up numbers, then it performs this. Oh, great, whoop-de-doo. But what happens if you sell it at a 10 cap, right? And for those of you who aren't familiar with what in the world I'm just talking about, it's called cap rate or capitalization rate, which is a function of how much net operating income the property produces. I'll just use a quick example. If the net operating income is $100,000 and you bought it at a 10 cap, that means the property's worth $1 million. So, the lower it is, or the lower the cap rate is upon sale, the better it is for the seller and the worse it is for the buyer. So you want to find out upon disposition, what if we dispose of this at a higher cap rate, which is better for the buyer than what we bought it at? What's that do to our deal? So I don't know. I've probably again wandered, but that's those are some of the things that we put in, is just to really stress test each of the deals and see how they perform over a variety of market conditions, including interest rates. I mean, where are those going to go? Who knows? But if our deal makes money at 7%, paying a 7% interest rate when we refinance, if it's bridge debt, great. Well, that's good. And then that gives us, quite a bit of float on a particular deal, and that's great. So yeah, those are some of the things we do.
Yeah, I think that absolutely makes sense. I think pretty much, in my opinion, like every passive investor should get the spreadsheet of their GP and just like look at like the exact derivation of the return, where it's coming from. They might be assuming like an overly aggressive exit cap rate or whatever. It can be like, oh, all kinds of drivers. So absolutely agree. And yeah, we're over time. I have a couple more questions. So don't you think that storage has much fewer levers to move the needle to add value as compared to multifamily? Appreciation typically much better than cash flow, was favorable depreciation for residential versus commercial, i.e. storage property types?
Yeah, it depends. Again, every deal is going to have its own story behind it. And so to say in general that storage, fewer levers, well, what if there's acreage behind it to develop it? What if it's fully occupied and they haven't done maintenance on the building? Okay, well, we're buying 20 acres and there's 10 acres that we can add more storage to. Do we have fewer needles or do we have more? Or fewer levers? Now we've got all kinds of levers. We can add storage, we can add fencing, we can add, there's lots of different value add plays in each asset class, and even within each asset class, within each particular location you're looking to buy, you got to find those levers that make sense and see if it pencils out. So, one asset class over another, not necessarily. Appreciation typically much better than cash flow, favorable depreciation for residential versus commercial. I don't know what that means. I don't know what that means necessarily, but maybe Richard can explain that. But I would say in the depreciation on the commercial side, it's you're especially with bonus depreciation on multifamily assets and even self-storage assets, there's bonus depreciation. So no, there's not as much to depreciate. Of course, there is better depreciation in multifamily than there is in self-storage. But no, you can get huge returns on your depreciation and cost segregation studies in both of those asset classes.
Okay, cool. Yeah, next question. I think I know the answer, but is it possible to invest a self-directed IRA 401k into a syndicate?
100%. Yeah. And I talked about that just a few minutes ago where, I said, hey, look, one of the things that I do with my own retirement funds is invest in other syndications. But yeah, absolutely. 100%. I strongly advise it. In fact, if that's where you want to dip your toe in the water, that's a great place to start, because you're not dipping into, maybe immediate cash that you need for living expenses or emergency funds or other things. It's money you don't plan on touching for a while anyway. So, yeah, put that in something that can grow. It's a great way to begin investing.
Mm-hmm. Yeah, and the next question, do you use Class A and Class B equity structure? It seems sponsors are using this structure, but I think these structures increase risk to the Class B equity investors due to the added debt.
Yeah, and again, you have to look at that based upon each deal. We do use an A and B, but it might be different maybe than what this question is asking. Structures increase risk to the B investors out of debt. I don't know. I think we came in, the general partners in our deal are the B investors. Class A gets paid first. They're the 70% of the deal. So I'm not sure I understand the risk due to the added debt. I don't know what that means. I apologize.
Okay. Yeah. If Carlos, if you wanna ask your question, it's okay. And please go ahead. And if anyone else has a question, maybe last question before we wrap up.
Can I go ahead and just clarify that last question for you?
Yep.
Yeah. In terms of the Class A, sometimes that Class A is more debt. And sometimes they'll show that the loan to value on the property or loan to cost is like 70% or something like that. But then the Class A, when you incorporate that can pretty much bump that debt up to like sometimes 85 or higher, depending on how much they're accepting on that Class A.
Absolutely. Yeah. You bring up a good point there, Carlos. And I appreciate you bringing that up. And this was something, again, I didn't cover this structure in the presentation just because, once again, for sake of time. But yeah, you're absolutely right. I mean, because now you've got somebody else in front of in this case, you're using A and B, and each deal will have its own arrangement. So A and B will mean something entirely different in a different, in a different opportunity. But in this case, if Class A is debt, then yeah, your class A has to get paid before your class B. So yeah, you're right. They're driving up the loan to value quite a bit. And really it's bringing up more risk because class A is now debt and they're going to get paid before your equity. So yeah, it's not necessarily a red flag, but it could be something that would, maybe cause you to inquire further as to why they need more debt and less equity. Yeah, that's an interesting, that's something I would certainly want to know more about before I plunk my money down in that deal as to why they're doing that.
Yeah, because looking back on some of the deals I've looked in the last couple of months, it appears like they'll usually show like maybe 75 or 70 loan to value or whatever. But they don't show it with that added debt. So then, people will be thinking, okay, well, it's a 70 loan to value. That's safe enough. But then if they calculate the extra debt that extra class is bringing in, they can bump it up. You can be up as high as 90, 95% leverage on that property without even knowing it. And that would
Correct.
definitely, if that goes beyond what you're willing to accept and not know it, you can be investing in that thinking you're in a 70 or 75 loan to value.
Yeah, you're absolutely right. And that's something to take into account. On the other side of that coin, though, is that now your equity is worth more. So if you have somebody that is really willing to roll the bones a bit and all they have is debt, then their debt partners, the class A debt partners, are not going to participate in any profit sharing and or any upside upon disposition. So while you are diluting or increasing your debt, you're also driving up the potential returns for your equity side. But again, for you and me, Carlos, that might be too much for us to take on. And I don't invest in deals like that myself, just for the very reasons you just mentioned.
Yeah, it just depends on the amount of risk you want to take on, right?
100%. But if you're going into it eyes wide open and say, hey, this is the terms of the deal, and we know that there might be a little bit more risk involved, then it's not all bad. Just again, something to be absolutely aware of. Thanks for bringing that up.
Well, thank you for the response. Appreciate it.
Yes, sir. Thank you.
All right, thanks so much. So Sam, that was absolutely awesome. Really appreciate, again, taking the time to talk to us today. Like, what's of great value. We had a lot of questions as well. That was great. So thank you so much, and thanks to everyone who joined as well. If you want to share your contact information one last time for people to connect with you.
Are you asking me to do that, Stefan?
Yeah. If you wanna put out your contact information once again, that would be great. Up to you. Up to you. Other than that, yeah.
Absolutely. Yeah, there's the link there. I just put that link in the the bit.ly link, which will take you to the presentation. If you want to download that, please feel free. I've also just stuck my email address in here, and I'm actually going to stick my my phone number in here as well, where you guys can feel free. And will you share this presentation with the group, Stefan, when you're done, or how does that work?
Yeah, absolutely. I did get a few requests. So if you'd like to share the slides and you send the link as well, that's great. And I could also forward to some people who would email me over if they didn't manage to get the link as well. So that's great. Thank you so much.
Thank you guys for being here tonight. I do appreciate it. It was an honor to be with you.
Have a good night.